Hello everyone. So through this video, we will conquer the national income problem and let's make this our strongest area in macroeconomics. So we'll cover past year questions along with other examples for having concept clarity. Along with that, we'll be having tips and tricks so that we can memorize the formulae so easily. The three fundamental relations. Firstly, between gross and net. Then national to domestic and market price and factor cost. We'll address them one by one. The first one, that is gross to net or vice versa. When a term is given in net, we'll add depreciation to it to make it in gross terms. Another name of depreciations are consumption of fixed capital or current replacement cost. Let's understand this with an example. Suppose that NNPFC, which is given as 560. Then we do have consumption of fixed capital and we are asked to compute GNPFC. Let me tell you that in normal course, in the examination, this NNPFC will not be directly given. So through some methods, we need to find out NNPFC, then we need to solve this. The thought process will be the same in computing the overall national income question. We are moving on to it. So firstly, we will identify what we should do in such cases. We do have NNPFC. So what we have should be written on the left hand side. And what is to be computed, that is GNPFC, is to be recorded in the right hand side. And the next step will be to strike off the terms which are common in both the sides. We do have national product in both the sides, we'll strike it off, and factor cost as well. So the only thing is we need to convert net to gross. So for that, we know that the thing is depreciation. Consumption of fixed capital, if it is given, it is just same as depreciation. Do remember this. So we'll add depreciation and we'll arrive at 600. That is your GNPFC. So yes, that's all about depreciation. Now from national to domestic, what we have in between is called as NFIA, which is net factor income from abroad. So which can be further formulated as net income received from abroad minus net factor income paid to abroad. In order to remember this, in a letter we write from address first, then only we will go on to address. Okay, just like that. From abroad, what is received minus what is paid. So in the example, we do have GDP MP, which is 400. So what we have on the left hand side, the thought process is the same. Okay, and we need to compute GNP MP, which is to be written on the right hand side. Then we'll strike off the terms which are common. Do we have something common? Yes, G, gross is common, so we'll strike off them. Then market price is also common, so we'll strike market price in both sides. So in order to convert domestic product to national product, we need to add NFIA, and it can be further formulated that, from abroad, received minus paid to abroad. Why am I stressing these simple things like from address and to address is because in the examination hall, we should not be confused like what comes first and all. That's why. So GDP MP is directly given, then we'll add NFIA and we'll arrive at 440. Now the next relation, that is market price and factor cost. We do have the thing in between them as net indirect taxes, which can be further formulated as indirect taxes minus subsidy. Okay, don't expect them to give you net indirect tax as such. So you need to further formulate it as indirect taxes minus subsidies. Now on to the example. We have GNPFC, which is 800. We are asked to find out GNPMP. Okay. So the same process what we have on the left hand side and what we want on the right hand side. We'll strike off the like terms G and net national product. Yes. Now what are we left with? We need to convert factor cost to market price. For that we know that net indirect tax is to be added to GNPFC. So yeah. On the question, of course, net indirect tax is not directly given. So, of course, net indirect tax is not directly given. So, indirect taxes minus subsidy will give you net indirect tax, which is 60 minus 100. Since 100 is the bigger term, you'll arrive at an answer which is negative, that is minus 40, and 800 minus 40 plus of minus 40, that is minus, will give you 760, which is basically your GNP MP. Now the relation sets are completely over. Now we are on to the bigger questions. So for solving the straightforward long question, you need to have a grip on to the steps. You need to have a thinking or thought process in your mind. First thing is to identify the method. We're having three methods, which are basically the first one, that is product or production method, second one income, and third one expenditure method. Now the second one, that is basically writing the golden formula. So which is the main formula of each and every method that we are going to use. For example, in product method, GDP-MP is equal to value of output minus intermediate consumption. It is a main formula that we will use. Okay. Now the third one, that is we will break it down. Which means, for example, this value of output will not be directly given in the question. So you need to have another formula in which value of output is equal to sales plus change in stock. You will not be able to understand everything at once. I'm just making you understand. You will be clear when we are going deep onto it. Now the fourth one, that is linking the resultant to the requirement. So for example, see, in the previous examples, we did had like GNPFC, which was given. This is what is meant by the resultant of the golden formula. By solving the method, we'll get something. That is the resultant. And what we want to compute, that is the requirement. So we need to link the things. Here we linked GNPFC to GNP-MP, right? Same process we are going to do. The only thing is GNP-FC will not be directly given. That we will compute with the formula and then we'll link the terms. Then, just like we have done before, we'll rule out the terms. Okay. And we'll just solve it. It is an easy cakewalk for you all. Let's move on. The first method, that is the product or production method, which is the easiest of all methods. The formula goes like this: GDP-MP is equal to value of output minus intermediate consumption. So, value of output, of course, it will not be directly given. So, value of output is equal to sales plus change in stock. So, yeah, just think of it in this way. See, value of output means what? The total thing that we are producing as a company, as a corporate, what we are producing. And if it is national income, it's about the whole of the country. Okay? The total value of output, the total production will be the sum of either that produced goods will get sold or it will be held as stock. So the total value of output will be sales plus whatever change in stock. Why change in stock? Because we do want the thing which pertain to the particular year in which we are dealing with. So the closing stock at 31st March, which is at the end of the financial year, and whatever that actually belong to the previous financial year will be present in 1st of April. So we need to deduct the opening stock from the closing stock to get exactly what belong to the current year in which we are dealing with. That's why sales plus change in stock. Otherwise, we have another formula that is units into price, which is we need the value which is to be in rupees, so units into price, which is less often asked. Now, yeah, GDP-MP is also called as GVAMP, gross value added at its market price. Now, we have an example. We are asked to find NVAFC. We do have different terms which are given in the question. So, yeah, the first one you'll be somewhat confused. Just move on to the second one, that is intermediate consumption. Sometimes in the bracket it will not be provided directly as intermediate consumption. Somewhere they will use this term that single use producer goods. We need to detect intermediate consumption, then of course sales, unsold output, and net indirect taxes. Suppose this kind of question comes in the examination. Through these terms, that is intermediate consumption, sales, output, through these terms, we need to identify that these terms actually belong to the formula of the product or production method. That's how we'll identify which method is to be applied. And then we'll move on to the golden formula, that is your step 1 in this particular question, because we already know that it's a question which belongs to the product method. Yeah. So GVMP is equal to value of output minus intermediate consumption. Value is equal to sales plus change in stock minus intermediate consumption, which will arrive you at 17 lakhs. Next step is conversion. We got the resultant of golden formula, that is GVMP, and the required one, that is NVFC. So value added is common. Apart from that, we need to convert gross to net as well as market price to factor cost. So gross is the bigger one because gross means the add up, the sum of value. So in order to convert gross to net, what we need to do is we should subtract a term. Which is that term? Just try to remember. The term is depreciation, right? So from gross to net, gross value minus depreciation will give you the net value. So the GN part, it is done. Now the market price to factor cost. Market price is after taking up all the taxes and all. So market price is the final price, no? So in order to convert from market price to factor cost, we need to deduct net indirect taxes. We need to take out the effect of net indirect taxes. So minus net indirect taxes. Net indirect taxes by chance directly given, so we'll arrive at 14 lakhs. Make sure that you write that lakhs as well, because just mere 14 will not work out in the examinations. I hope it is completely clear. Now we are moving on to the next method. That is basically income method. And COM is highlighted or is in bold for a purpose, because NDPFC is a resultant of the main formula, or we can say, yeah, golden formula. First one is compensation. C for compensation of employees, O for operating surplus, and M for mixed income. Because so why you should learn those terms? Because sometimes it will be directly given, so that things will become much more easy for us in the examination. Suppose compensation is directly given, just take it as it is. Okay? You don't have to further take as like wages and salaries, social security contributions. No need. Why employer? The term is highlighted. Why? Because when we are taking something, the social security contributions by employee, it is from the wages and salary which are already being allocated. So again, when we are considering it, it will lead to double counting. And cash or kind, both are considered. Then operating surplus. Rent, royalty, interest, and profit. Profit will not be directly given. Like corporate tax is paid out of profit, then dividend is to be distributed, and some part will be retained. This all constitute from the profit itself. That's why we are adding it. And in some cases, dividend plus retained earnings as a whole will be directly given as after tax profit. Because after corporate tax, whatever is left is divided as dividend and retained earnings. Now we can move on to the example. calculate domestic income. Domestic income is actually NDPFC. NNPFC is your national income, so NDPFC is domestic income. Domestic product will come in between, that is domestic income. National income, NNP, national product at factor cost. Okay. So we do have dividend, social security contributions by employer, okay, corporate profit tax, consumption of fixed capital, retained earnings, interest, rent, royalty, wages. Then lastly, one term which is highlighted, that will move on. Okay, so from these terms we will be able to understand that it is income method if it comes in the examination. It was past year question, so of course, yeah. Oh yeah, COM, that is a memory technique. So the first one is C, that is compensation of employees. What we are compensating the employees with? Wages and social security contributions by employer, which is actually given in the question as 600. And we do have social security contributions as 40, right? Let me clear it out, okay? Yeah. Wages and salaries, the second last thing, that is 600. Then social security, the second one, 40. So we'll add it up in order to get the compensation of employees as 640. Now the second one, that is operating surplus, which constitute all the residual terms like interest, rent, royalty, profit. Okay, so these are the things we need to find out. In the question, as we can see, there is interest, which is given over there, rent, royalty. Then yes, profit is actually subdivided. See, corporate profit tax is given, then dividend is given, retained earnings is also given. So we need to add them all in order to arrive at the element profit, which is basically 100 rupees. Sorry, 100 crores. Yeah, I made a mistake right here. So profit is equal to corporate tax plus dividend plus retained earnings. So do refer this, okay? Please have a concept clarity on this and memorize this. Corporate tax, dividend and retained earnings will give you profit. It is often asked in the examination. And yeah, dividend and retained earnings is somewhat called as, referred to as the after tax profit. So that's how we solve the question. Yeah, we are picking out the terms, and of course it's somewhat easy for you right now. Then mixed income is of course not given in the question, so yes, only two terms, that is compensation and operating surplus, that gives you 990 crores. Now the term which is highlighted over there, since the loan was taken for consumption expenditure, it will not be considered. Something which is for the production of goods and services and factor payments are only considered. That's why. Now the final method, that is our expenditure method, which is somewhat easy. So the golden formula and the resultant is the same as the first method, that is product method, that is GDP-MP. One is PFC, that is private final consumption expenditure, then government final consumption expenditure. These terms will be directly given. That's why I termed it as easy. Then gross domestic capital formation, that is something which is tricky. Then the last one, that is net export. Why tricky? Because we actually, as a term, we need gross domestic capital formation. We need to be careful with this, because if gross domestic fixed capital formation is given, then the word fixed is there, no? So we need to add net change in stock in order to get gross domestic capital formation. So if fixed is there, we need to add net change in stock. What is change in stock? Closing minus opening. Okay, just think about it in the alphabetical order. Okay, closing minus opening. Don't do it as vice versa. Okay, so that is net change in stock. And why gross is highlighted means what? Sometimes net domestic capital formation will be given. So in order to convert net to gross, we'll actually add depreciation. We all know it. Okay, so we need to be very particular about this, that we actually need gross domestic capital formation. Take it onto your mind. We need gross domestic capital formation for the purpose of expenditure method. When you're seeing that term in the examination hall, make 100% sure that it is not net and it is not fixed. Okay. Now net export. Net export, as a word suggests, it is export minus import. If net import is given, we should take the negative so that we arrive at the net export. Okay. Now a question in which they are actually asking us to compute the national income, which is basically NNPFC. We'll move on to the question. PFC, GFC, net imports, fixed capital replacement, change in stock, net domestic fixed capital formation, net indirect tax, NFI profit. From these terms, we can identify that it is actually expenditure method. So our golden formula, that is GDP-MP is equal to PFC plus GFC, private final consumption expenditure. FC is actually final consumption expenditure, and the other terms. The term that we should actually take very seriously is gross domestic capital formation. See, we are provided with net domestic fixed capital formation. So for net to gross depreciation, add depreciation, then we are having fixed. So for that purpose, we need to add change in stock. So 180 plus 50 plus 250 will give you 480. Now we have net imports, that is import minus export is net import. But what we need is net export. So what will we do? We just take the negative of net import to convert it into net export. So yeah, let me just clear it out. And by the time, make sure that if expenditure method is being asked, gross domestic capital formation and net export should be the term in your answer. And that should be taken out from the question. Don't make a silly mistake. And there is further explanation which is given, that is, yeah, why we are taking the negative of net imports. I hope you can understand that, because net import is something like import minus export, so it should be taken as export minus import, hence we are taking it as minus of net imports, that is minus of 30. Okay, and we'll arrive at GDP MP, which is basically 1750 crores. How? Because the first one, that is private final consumption expenditure, which is there in the question. Then government final consumption expenditure is also there, directly given in the question. Then we did some work for gross domestic capital formation. And the last one, net export, which is took the negative. Let's check it out with the question out there. Yeah, PFC 900, GFC 400. Then yeah, net imports, we took the negative. Then the capital. Yeah. Gross domestic capital formation was what we needed, and from the term given out there, we actually converted it, because fixed capital replacement cost, I already mentioned it, it is equal to depreciation. It is another term for the word depreciation. I hope it is completely clear for you guys. And finally, the conversion to NNPFC, in which we are so good in. So yeah, I hope the video is helpful. Thank you.